everybody. This is Rob Keens from the Freedom Report, and I have some very special guests returning to the program. It is Kevin Wadsworth and Patrick Kareem from Northstar Badcharts. We're recording this on January 5th, 2026. You guys will probably see it the day after. Welcome, Pat and Kevin, to the program.
Hey, Rob.
Thanks, Rob, for inviting us on. It's always good to catch up.
Yeah, absolutely. So what I want to have you guys to talk about was a preview of what 2026 looks like for the markets, specifically precious metals, but also what you guys are seeing capital rotation, taking a look at what's happening to the stock market and where commodities and specifically gold and silver are going to be for 2026. I know you guys have a lot of insight into that. You do a really great show on the Kinesis channel as well. Well, people can follow you on Twitter. Give us your insights into what's going on, and in particular, I want to talk to you about, maybe I'll highlight some of maybe the misinformation going on in the precious metals markets right now about what's happening, and maybe you guys can clarify what you see from your perspective.
Okay, well, if Pat wants to talk about what I'm just about to show, I'll just set this up for Pat, and then Pat can explain in a bit more detail. So 2025 was all about the capital rotation process. Anybody that follows me will have seen my pinned post from October 2024, which spoke about this capital rotation process and what it meant. And what it means is that gold and silver are in a developing era where they outperform not only stock markets, but a broad range of risk assets. So we're talking about a number of indicators here that when they come together, give a weight of evidence that gold and silver and associated commodities, energy and oil are moving into an era. And what I mean by that is a period of several years where they outperform the stock market. And you can't just look at one chart, Rob. If you're just looking at one particular chart of, let's say, gold versus the Dow Jones, well, gold may, break out versus the Dow Jones at various points, but you have to bring that together with a whole range of other pieces of evidence before you can start saying that something significant is happening. So a number of years ago, I put this sort of matrix together, started bringing together this idea of weight of evidence. And US money supply moved into a bear market versus gold quite a long time ago now, at least a couple of years ago. And the US dollar index, that's the measure of the US dollar relative strength versus primarily the euro. So when that relative strength for the US dollar moves into a bear market versus gold, it's one of the indicators that we're now entering a precious metals bull era. Consumer prices and producer prices are both well and truly in a bear market priced in gold, as is currency in circulation. It's in a bear market versus gold, a bear market being below key bull market support levels, below key moving averages, and below indicators such as one that we use primarily is called the Ichimoku cloud, technical indicators that define bull markets and bear markets. So when we say it's in a bear market, we're using a number of metrics to define what is a bear market. The equal weighted S&P, SPXCW, that's if all the stocks in the S&P were given equal weighting, that moved into a bear market priced in gold a long time ago. The New York Composite Index, bear market priced in gold. The Dow Jones is in a bear market priced in gold. The Wilshire, the Russell. Now the S&P is arguably, and the Nasdaq arguably, in a bear market priced in gold. I've been very sort of cautious with sort of declaring a bear market priced in gold, but they're now both below support levels on their ratio charts versus gold, both below key moving averages and both below the Ichimoku cloud. So I think we can say that we're in a bear market territory now for the S&P and the Nasdaq priced in gold, but there's still a little bit more work to do that involves a capital rotation event. And if people have been reading this text whilst I've been talking, they'll already know that this whole process of gold moving into or these instruments moving into a bear market priced in gold, all of that is what precedes or is associated with, depending on the type of process that's going on, a capital rotation event. And the event itself is defined by a substantially weakening stock market in nominal US dollar terms. So all of this is great. Gold has been, it's doubled. It's doubled from 2000 to over 4,000. Silver has gone up 160, 170% or more in the last sort of 12, 18 months. So that's great. That's, gold being really strong. But what we now need to see for this event is a corresponding downturn for the stock markets priced in US dollars. And that's what happened when all of these things came together around about 1930, where the capital rotation event. Same again in the early 1970s, around 1972, and the early 2000s. And we know what happened on these dates. Commodities, precious metals, even though gold was pegged, it had to be repegged here. And silver, if you look at the silver chart, you can see silver accelerating upwards at all of these points. So all of these were precious metals and commodities, energy and oil bull eras. So that's where we're at. 2025 performed as we anticipated, i.e., precious metals massively outperformed the stock market and massively outperformed Bitcoin and cryptocurrencies by a very, very wide margin. And that was no surprise to us because that's what we've been forecasting. So 2026 is now a case of what happens next, Rob. So I don't know if Pat maybe wants to add some to that, but 2026 is the next stage of this process.
Well, before you go forward, if you can put that chart back up, I do have a couple of questions for you to help the audience understand. You were talking about, I have two questions, one on the weighted index and then on the bottom two. So on the weighted
Sure.
index, SPX, EW, a lot of, I think in the S&P, there are some dominant stocks that tend to skew it. Is that why you did an equal weighted index, or can you explain why you put the equal weighted index in there?
Yeah, of course. Well, it gives an earlier indication that there are a small number of stocks. And if I just show you that chart, the equal weighted S&P versus gold, just let me get it on my screen here. Let me just find SPXEW. Give me a moment
Down
to think.
there. Oh, those are the index over SPX.
Yeah, it should be up here. Oh, there we go, at the top.
There you
So
go.
SPXEW, this is the equal weighted S&P versus gold, or priced in. When we say versus, it's just like saying priced in gold. And what you can see here is that the rotations that take place on a cyclical basis, the rotation away from the S&P towards gold when this chart tops, and then away from gold towards the S&P, as in 2011, when the chart bottoms. So you can see these cyclical rotations, and it was very clear when we went a number of years without the equal weighted S&P making new highs versus gold, that there was a problem for the stock markets, the equal weighted stock market anyway. And then it began to break down through support lines, through the Ichimoku cloud. And if I was to put the 36 or 48-month moving average on there, you can see the price broke below these long-term moving averages. So once you start breaking down below all of this technical chart evidence, you're getting a very clear indication that there's substantial weakness for the equal weighted S&P versus gold. And you can see how far we've fallen. And if I was to measure that for you, you can see we've fallen, what does that say? About 50, 53, 54%.
Yeah.
So that's a very large drop for the equal weighted S&P priced in gold. And in fact, and I keep pointing this out, it peaked 25 years ago in the year 2000, as did all of the stock market indices, peaked versus gold in the year 2000. And we had a big bull run for gold, and then a sort of I call it a bull run for the stock markets versus gold. But during that bull run, they never made new highs priced in gold. I could show you the Dow versus gold chart, for example, the same thing on Dow versus gold. If I just zoom out, you can see that it peaked back here in the year 2000, so 25 years ago. That's when the Dow versus gold chart peaked. And then it plunged as gold doubled and then doubled again and then doubled again. And then it's rallied and now rolled over again. So this very clear, and I'll just put it on the quarterly time frame for you to make it even clearer. This, I could show you the S&P versus gold or the NASDAQ versus gold. It's the same thing. The chart has gone up as the stock market's outperformed gold, and now it's plunging as gold is outperforming the stock market. And each of these signals, 1930, around 1972, the early 2000s, and now, they're all indicative of a precious metals bull era where gold doubles and then it doubles again and then it doubles again. And the stock market, depending on the type of event that's taking place, will either plunge as it did in the 1930 example, or in the 1970s example, the stock market rolled over on three separate events, each event slightly larger than the previous one, culminated in a drop of roughly 50% for the S&P. And of course, in the year 2000, we had a 50% drop in the S&P, and in 2008, we had another 50% drop in the S&P. In talking in very broad numbers, it wasn't exactly 50%, but it was roughly 50% on each occasion. So the key thing that happens is that the stock market goes nowhere for 10 or 15 years. It doesn't matter how the breakdown occurs, whether it's one massive drop or whether it's 2 or 3 different drops for the stock market. But during that 10 to 15-year period, the stock market gives no returns compared to its peak, whereas gold, as I said, will double again, and silver will rise by quite possibly many hundreds of percent, even over 1,000%. So that's the capital rotation process that we find ourselves in now. I think 2026 could well give us a back test of this pattern, so that at some point we see the charts moving back up again as the stock markets and cryptocurrencies outperform gold, as precious metals perhaps correct more significantly, and then we get a much bigger drawdown later on. So whilst gold and silver are still holding up and doing very well, they're clearly starting to get very historically extended. So, for those who are long-term investors and stackers, great, hold your positions. If you're not worried about a 30 or 40% drop in precious metals, 25% drop for gold maybe, and 40% or more for silver, which is what very often happens in this situation. If you're not worried about that, if you've got your eyes on the long-term, much higher targets for gold and silver, and those targets are many times above what we are at the moment, then investors and stackers, they can just hold their positions and add to them. It's only if you're a trader and you're on the sidelines and you're waiting for a low risk trade entry, then you need to wait for sentiment to reset.
Hey, Ken, I think I saw a new line there from 1988 to 2012 there. Can you create a possible line, 1988?
1988 to 2012.
Yeah,
Here.
That the low, yeah, under that there, the low that, yeah, stretch that 2012, raise it. I'm wondering if that's where it's going to bounce.
It could well be. It could well be. Of course, as technical chart technicians, we're always looking for downside support to identify where. Yeah, that's quite plausible.
Maybe that, right? Maybe.
And that could well lead to gold reaching its next Fibonacci extension level, which is up around somewhere, perhaps around 5,300. It's I've done a Fibonacci extension on this that involves the low point in the year 2000, the high point in 2011, and then the low point here in early 2016. And if you use those 3 points, the Fibonacci extension level is somewhere above $5,000. And of course, gold is holding up at the moment. If we take a look at the gold chart on a small time frame, it looked as though it was about to break down, and it's holding support at the moment, holding that horizontal support. So for the time being, gold lives to fight another day, and perhaps has its eyes on a slightly higher level before that major correction starts to come in.
So you're talking about a correction, not a true reversal, but a correction. What's your time frame for that for the metals?
Well, on this type of historic breakout, the question has to be whether we actually retest the original breakout. I know a lot of people are not even prepared to accept the idea that gold could do this.
Holy Moses, Kevin, you're scaring everybody. Why are you doing that?
Yes, it's
everybody just clicked off the video and said, "I'll forget."
Yeah, exactly. How to lose your audience.
Yeah.
So that would be somewhere around about $3,000. Well, 5,000 to 3,000, that's a 2,000 drop. That's what's that, 40% or so.
Yeah.
It seems extreme, but given the numbers that are involved and the size of these patterns, it wouldn't at all surprise me. But as you've probably spotted, there is a Fibonacci support level in there that may sort of act as support somewhere near $3,500. So the point here is that mentally you have to be prepared mentally for a significant drawdown, and be prepared to take action depending on what time frame you're trading and investing on. People sometimes say to me, and Pat, should I buy? Should I sell? there is no one answer to that. There's no one size fits all. It depends on whether you're a trader, whether you're a day trader, whether you're a position trader, a swing trader, whether you're an investor, long-term investor, or indeed a stacker, because you have different methodologies based on what it is you're trying to achieve and how much of your NAV is invested in each of those timeframes. Because you can invest for the long term with the bulk of your NAV if you want to, and trade with a smaller proportion of your NAV as well. And of course, you may have some of your NAV in silver, which is doing very much the same thing at the moment. It looked as though it might possibly break down below the area around 70, just above $70. Instead of which, on the 4-hour time frame, it's formed a nice bullish pennant from which it's broken out and seems determined to continue its uptrend for the time being. So silver is following much the same.
Stopping you right there. So if silver is in a little bit of a bull, your understanding of historic movements in gold and silver, gold usually moves first, silver second. Is this breakout in silver, what could the length of that be? And would it be that it's breaking out as gold is plateauing and coming back down? And would silver then follow it back down? Or do you think that there is a typical pattern, or can you rely on a typical pattern? And I'm really talking more from like a gold silver ratio perspective. A lot of people follow it. Is there a way to trade that, or is that a little bit too dangerous based on your experience?
So you have to be aware the gold silver ratio just, of course, gives you relative performance. Do you want to talk about this, Pat? I feel like I've been talking all the way
No, no,
through.
no, no, I'm enjoying the show, Terry. It's great.
Okay, then. Well, the gold silver ratio simply tells you, if I just zoom out a little bit, simply tells you which is outperforming the other. It doesn't tell you whether they're going up in dollar terms or down in dollar terms, of course. So all it's telling you is which is the relative outperformer. But you can apply technical analysis to the gold silver ratio as much as you can anything else. And by seeing that we broke down below the support line back in October, it became clear that something bigger was developing for silver, and I kind of expected it to bounce off that support zone there, but it just sliced right through it and is continuing to find to sort of plunge down and find or look for some horizontal support, which might be in that sort of area there, perhaps somewhere around about. Let me just extend that line across a little bit, somewhere around about 50 or so on the ratio. So perhaps it's going to come down and test that horizontal support, and therefore, if gold's at roughly $5,000 or $5,300, you can divide that by 50 and get your sort of value, your anticipated value for silver. So you can use the GSR to help narrow down what your targets might be for this move for the price of gold and silver, as long as you've got some confidence in where gold is likely to go. But trading the gold silver ratio is, I mean, me personally, once this started to break down, I saw that and shifted my positions into silver, because clearly, until it reverses, silver is going to be the outperformer. So that you can't, but it's not easy even for chart technicians like me and Pat. It's not easy to trade the gold silver ratio, because as you can see, back in 2020 here, it's plunging away very nicely, and then suddenly it reverses and gold starts outperforming. So as soon as we start getting a correction in the metals, you would expect gold to outperform, because during a steep correction, silver being more volatile and it's the smaller market, silver will give back more of its gains more rapidly than gold. So the ratio will start to reset and move back up again. And then that can give you the next entry point for switching back into silver, because you'll be able to anticipate that when the correction is ending and when the corrective pattern is breaking out to the upside. One thing I do want to show you though, Rob, is something that perhaps a lot of people don't look at, is the S&P versus silver ratio on the quarterly time frame. And Pat and I have been sort of developing the idea of what we call a super capital rotation event, not just a regular CRE, but something a little bit more dramatic, if you want to put it that way. If you look at the pattern that developed in the 1920s, 30s, all the way up to the 1970s, we had a developing support line for the uptrending ratio for the S&P versus silver. We had a big drop there in the 1930s when silver outperformed the S&P, and another big one when this massive pattern broke down in the early 1970s and silver went absolutely nuts. Now, you can talk to me about the Hunt brothers cornering the market, and you can throw all sorts of narratives at me. And there are narratives why this chart plunged here, and there's narratives why it plunged in the early 2000s. But you don't need a narrative when you've got a chart. All you need to know is that the ratio broke below the support line. Whatever narrative people decide to attach to it, I'm not really particularly interested. So, what I can say now, if I just pop this back onto the candle chart for you, and we'll try and talk about where this might halt for the time being. We're getting very close to touching these yellow and orange lines on here, which are the support lines based on the weekly and the monthly time frame. So this at the moment is the quarterly chart, and on the quarterly chart, the red line is the support line. If I put it onto the monthly time frame, the orange line becomes the support line. And if I put it onto the weekly time frame, the yellow line becomes the support line. So luckily for us, the yellow and the orange line are quite close together, as we are now at this point in time. So back onto the candle chart, and what you can see is that we got, if I zoom right in, we got very, very close to that support line. What this chart is telling you is that as it drops, silver is outperforming the S&P. Now, going back to the quarterly time frame and working out the similarities with what happened back here, 1, 2, 3, plunge, hit support, then silver stops its outperformance and then restarts again a couple of years later, and silver went absolutely crazy when the ratio dropped again. So here we go.
So it's a head
One,
and shoulders
two,
followed
three.
by
It's a
followed
slant.
by
It's a
re
sort of slanted head and shoulders. I mean, not all head and shoulders are
yeah,
textbook perfect, but this one's got its neckline on a tilt. And
yeah.
if I put the candle chart on for you, it might look a little bit clearer. So yes, it's a, you could call it head and shoulders type of pattern where you get this
You're getting some wicks, the
rollover.
wicks testing the support, but it doesn't punch through until it looks like a
Well,
head, sort of a head and shoulders there, but it's not really. It's almost like a head and three shoulder. So
yeah,
the
it's
patterns are slightly different.
you'll read the textbooks and there's a certain way that these things are defined
Hmm.
and a certain way they have to look. And the same thing goes for cup and handle patterns. Well,
Hmm.
after analyzing thousands of charts, I mean, Pat can tell you with some degree of certainty that the real world isn't quite textbook. So you have to,
Right.
and people are going to be screaming at me here, Elliott Wave, proponents and all the rest of it. There's a very specific way the wave count has to work, and people have become very, very attached to the absolute detail of this. But to just stepping back and looking at a broad view of it, all I'm really interested in here is that the support line, whatever you call the pattern, the support line there has broken, and the ratio chart began to drop. So it became
Yeah.
clear that the S&P was going to underperform silver, or silver's going to outperform the S&P. And that's what's happened. We've seen this massive move for silver as the ratio chart dropped. Now, we're looking for a reaction somewhere around about 80 on the ratio. We're at 90 at the moment, somewhere down near 80 on the ratio. So looking for some kind of reaction down there that tells us, with all the rest of the weight of evidence that we've been talking about, that silver is now going to go into, or will then go into some sort of corrective period. It could be next week, it could be next month, but certainly looking at the way this chart pattern's playing out, it's not very far into the future.
Mhm.
So, putting all of that together, it raises the prospect of some type of correction developing in the not too distant future for gold and silver. And you'll perhaps start to anticipate the stock market and things like Bitcoin and cryptocurrencies having a chance at least to outperform. And of course, we're seeing Bitcoin
If you
have
stay
a
on
chance
this,
to do that now.
if you go back to that chart for a moment, I want to make a commentary. So
Yeah,
people
sure.
that one of the things I suspect is behind the AI guy and the overall social media push, that there's a group behind it. Maybe I don't think it's an individual, but I think it's a manifestation of what we've seen in people. A lot of times when you see these markets develop, nothing goes in a straight line either direction. And people will get to a point where they try to drive a mania for their own purposes. But I do want to caution people that things don't go in straight lines. We've had a really great bull run the last 2 years in gold, and I'd say year and a half in silver. It's been great. but to be cautious about when those types of things come out that are one-sided, sort of pumping um, without cogent analysis, and also using things that aren't factual, such as secret meetings of the CFTC, and using those rumored things to uh, push forth a certain narrative. This type of analysis is much better because it gives you a lot of data and a lot of history to it and what people to expect. Things don't move in straight lines, they don't go one direction. But I suspect when you get into that super phase that you have there on the right hand side of the chart, that the noise around what this market's going to look like is going to increase. And one of the reasons I want to have you guys on is to provide more detail, more data around what a true market really looks like so that people don't just, and the reason I'm saying this, there's so many people new because of the recent mania metals, there are so many new people coming in. I want them to be cautious about listening to just social media or any sort of narrative that is trying to push a single story without looking at, all sides of it and without looking at some context and history, if that makes sense.
But you got to be careful because those storylines, they will remain the same. Even let's say we went for 10 years and the storylines will get even more bullish as price supports it. It's like a people, they have a narrative, the price goes up, and then it reinforces, oh, well, if my narrative was correct. But then what happens at the end of a 10-year bull run, 15-year bull run? The narrative is not going to change, but the price is going to start slowing down. The price is going to start falling apart. But the people who bought on the narrative and they don't look at the objective truth, the actual price chart, they won't know when to bail. And we've heard so many stories of the same thing. People riding the 2000 run or whatever and not selling whatever in 2012, 13 when there was evidence showing that was rolling over. So, there's always look at the charts, and people should seek refuge in the fact that Ken and I don't look out for narratives, because our argument is every single narrative, known and unknown to us, is the price chart, right? Because somebody knows something I don't know, and an Arab sheik somewhere, he's placing his bet. Then there's this other guy placing his bet. This American billionaire placing, everybody's placing their bets. But what we see at the end of the day, we just see the price chart. Manipulation, no manipulation, it doesn't really matter for us because we don't have to worry about that. All we have to worry about is doing a correct analysis like Kevin's doing. Are we below a declining moving average? Are the technicals falling apart? Well, that's all I care about, because the bearish news you will see at the bottoms and in bases, like horrible news, gold's going nowhere. When it was basing back from 2000 whatever 14 all the way to 2018 was doing its base. You had the people $900 target, $500 target, gold was useless, or even the ground bottom right back in the 2000s. But then if you look at the charts and you see they're starting to go upwards, you said, hold on, guys, who cares about these bearish narratives? Somebody's doing something. The aggregate of market participants are driving the price up. And it goes back to what Kevin said. Are you a stacker? Stackers don't care about the price. They'll just buy every week. I've known real stackers. They go at Kitco downtown somewhere, the offices, and every week they just buy it. They don't care about the price. If a stacker cares about the price, he is not a stacker, a true one. He's hybrid, he's trying to time the markets. But, you got to focus on that there. The super, going back to the original chart that Kevin put there, that matrix table, they weren't all like flashing red for the stock market at the same time. The SPX was flashing, bear market before the other ones. So once upon a time, these were all green and they were starting slowly to flash in the direction. But I'll tell you another thing. I'll answer my own question. When's the last time that we had the stock markets rolling over price in gold, or I say silver, rolling over in gold, while they were both going up in price? And Kevin could probably show up the chart. The last time that happened, it was not in the 2000s, it was not in the 1930s, it was in the late 1960s. So people forget, guys, got to stop looking at the gold chart. Look at the silver chart. Silver chart was unpegged for 100 years before silver and the stock markets were going up together in the 40s, the 50s, the 60s. Everything was going up together, but the stock market was outperforming silver during that phase. But step one, the big warning sign was, as we were heading into the 60s, mid 60s, silver was rolling over. The stock market was rolling over versus silver while both were still going up. And that's exactly where I think we are now. And that's in the context of the interest rates that were plummeting from the late 1800s all the way to the 1940s. And then after that, the bottom 50s, 60s, the interest rates were starting to go up. It's repeating all over again. We've had a huge bottom in interest rate. They're starting to turn up. Stock markets are up. Silvers are up. but silver's outperforming the stock market. That's step one, guys. Step two, the stock markets are not supposed to underperform silver. This is foretelling. I don't know, like it's foretelling that underlying weakness in the stock market. Eventually, we'll see some damage in the stock markets nominally priced in fiat. They will start rolling over. But I don't think I don't know. I don't want to project too much, but I don't think they're going to roll over as much as people think because what's helping support silver, all that inflation will probably help keep a floor under nominally the stock market. So the stock markets in the 60s, they had multiple plunges. It wasn't crazy, right? 30%, maybe then a 45%, then another 30. It's not like the end of the world because all that inflation is going to actually help the stock market support up nominally price in fiat. But the stock markets in the 70s, they lost 90% price in CPI. They lost whatever. They're going to get destroyed by all the other asset classes, but nominally it won't look that bad because of that inflation cycle. So the setup is a super CRE. No matter what gold does now, whether it goes to 4,000, 5,000, whether silver's at $100, the best years for silver are around the corner. After the next correction, the outperformance will just be crazy.
So what Pat's been talking about there is the green line there is the S&P in the late 1960s and 70s. It fell, then it recovered, then it fell, then it recovered, then it kind of went sideways for a while. Oh, that whole period there from 1968 to 1980, 12 years, the stock market went nowhere. Look what silver did. When the stock market had its first major drawdown, and that was probably something like 35% or so, silver went down with it. Stock market begins to recover, and on the recovery side, the blue line there, which is silver, look what happened. Boom, and then boom again. So whatever the narratives are, whatever, and you can see, you can go back to the 1930s and see a slightly different.
Show how silver was in a 40-year bull market or 30 years, whatever, 20-year bull market, way before we had the super CRE in the late 60s, early 70s.
So silver here in the bull market all the way from 1932 all the way through to 1980, up, 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 up. It's worth looking at silver instead of gold because, of course, gold was pegged and silver, as you can see clearly, was able to move much more freely on the market. So, it's a better metric if you wanted to look pre-1970s. So, yeah, as Pat says, silver was in a big bull market all the way through, much as it's been more recently, of course.
That's right.
If you look at the blue line there for silver, it's arguably been in a bull market really since 2000 there. I mean, it's kind of, yes, we had a hiatus there where the price of silver consolidated and corrected, but overall, I mean, you'd have to say it's just doing that, isn't it?
Yeah, gold and silver both have. Gold's outperformed the major stock market indices since 2000. And then in 2024, gold separated from that. Well, gold was roughly following CPI from 2000 to 2023, 24, roughly. Print government inflation, not real inflation, like shadow stats, real world inflation. And then 2024, gold really separated from that. It separated from the DXY, it separated from interest rates. And silver's begun to do that too. And what I think is helping put some things in context is we've already started to have a little bit of capital rotation into those assets, not necessarily from retail US buyers, stackers, but from around the world. You can start to see that people are rotating into those assets more. And I wanted to go back to something you said earlier and put it in context. When we go back to understanding narratives versus understanding human action, if you look at Austrian economics, economics is not a science per se, it is the study of human action. And something that you said, Pat, when you look at a chart, it's indicative of millions of different decisions from millions of different people who understand different pieces of what is going on in the economy. And then that chart is really telling the overall story. And so if you're just adhering to a single thought process or a single point, whether it be economic or fundamental to metals or whatever the case may be, that's where you may get stopped out of a trade if you're trading, or that's where you may be disappointed. For example, I'll give you an example. Guy comes into my coin shop a few years ago and he's really pissed off about silver. He's got a monster box of American Silver Eagles. He's like, I want to trade them for platinum. He said silver didn't do what everybody said it was going to do in the industry. And silver had gone up to 30. The CFTC had intervened. I have that video where Rostin Benham, the CFTC commissioner, admitted that they intervened. and they stopped silver at 30, and eventually it came back down. It was trading like 21 at the time, and he was mad. And I said, look, don't pay attention to current narratives. Silver's in a long-term bull market, and pay attention. And then what do we have now? We have mid 70s silver, and silver and gold are both up today. So really what I want people to get from this is there are a million things that go into making a market, and understanding some of these trends and counter trends and being able to look at them over time is very important. And to understand Austrian economics is in play here. The powers that be will try to engineer things, and they can't. The market always speaks. And those charts that you're showing are the market speaking, all of these millions of decisions being made. And that's really the way that you want to look at any market, whether it be the stock market, bonds, economic models, or the precious metals market. Is the charting really helps to give you an idea of the trend patterns, but it also helps you level up in your thinking about these markets, because one human being can't possibly understand all of the inputs into an economy and all of the potential repercussions. So I just wanted to summarize that in
Right.
general terms for people, and the reason I'm doing that is there are a lot of new people coming to the space. This is a very important process to do, and why I wanted to bring you guys on. So talk about moving into what you were talking about at the end, and sort of that correction phase. What could a correction look like before you get to the big capital rotation and the big boom? If you go back and, for example, if you're talking about the 60s or other past events, could that be instructive as to where we could go with gold and silver? And if people are trying to, and the reason I asked, I have one customer keeps wanting to buy a bunch of gold and silver right now, and I'm like, I think you may want to wait a bit and look for a better entry point. What could that entry point look like, just in general terms, for somebody that's wanting to put another 20, 30, 40,000 in, and we're looking at prices right now and we think they're going to go up forever, but there may be a better entry point coming up. What could that look like for somebody wanting to invest?
This is the number, while Karen's setting that up there, this is the number one thing we're trying to remove or help create a logic to a flow chart of decision making for people. Step number one, that guy he has to decide, is he a stacker? Is he a stacker? If he's a stacker, don't even talk about the price. That guy just say, you're a stacker, you want to hold it, you never want to sell it, you want to give it to your kids, you just buy it. You could be in the bear market, you buy it. If the guy he's a trend rider, but he has a 10-year horizon, 15-year horizon, then yes, he could buy now if he's riding the trend. Because if you go on the yearly chart, silver just broke out this year, right? It just broke out this year. He's riding a trend. He wants to get in. But how we define lower risk entry points, Kevin's going to show you, it's when we have coiled and tight patterns close to moving averages just starting to break out. Because that means I could over lever, or I could buy a big chunk right there. And I know the chances are, it doesn't mean like all breakouts work out, but I have less chances of getting triggered out of, like, having a huge drawdown on these huge, massive, important breakouts. And that situation right now is not there. Like the last time we had a huge breakout, it was late 2023 there. Even on the quarterly, Kevin, there's a beautiful breakout. That's the last time. That's why when there's a chart defined breakout, people, they better take heed, or they have to, that's the time, even the slanted one, Kevin, there, starting from 2011. Yeah, Kevin's drawing the times to go in long. Now, unless you're a stacker, it's very hard to tell somebody, and people might get mad. Patrick, you told me this silver was at 50. Patrick, you told me this silver was at 70. And let's say the price goes to 100. And people, Patrick, you told me this at 100 when it was 70 and now we're 100. You missed out. No, it doesn't change the fact. Even if the price rockets from here, it doesn't mean that the low risk entry was now. So your advice is good in the sense that we're so stretched from the moving averages, just objectively, even if silver doesn't melt up to 200 from here, you can't create out of midair a low risk entry for people because they want to enter silver. You can't just magically create these 2-year consolidations. If you missed out on those consolidations where Kevin put the circles, it sucks to be you, man. Tough love, guys. So next time you do see a 2-year consolidation and the narratives are bearish and it breaks out, maybe you should buy, or take it. Those are your better chances, those breakouts there. But right now, it's the price is in la la land. It could double from here. But unless you're a stacker, unless you have a 10, 15-year horizon, it's just crazy buying here, right? It just does not make sense. And it's something very hard for people. I'm trying to find different analogies. Maybe, Rob, you could come up with something creative to explain to people that from a risk to reward perspective, You don't buy except when you have those circle spots there. All those circle spots Kevin's been identifying, because we're trained, like we've looked at tens of thousands of charts. We've spent like 30, 40,000 hours doing this, and we've identified those lowest areas where nobody wants it when the moving averages, scientifically, mathematically, they're coiled and tight. Those are the entries when you're starting to explode away from the moving averages. The bottom pane is the distance of the price from that 36-month moving average, from that thin blue line. That's mathematically where you want to go when the money's just starting to go in. Now, look how stretched we are. We are stretched as we were back in 2011. If Kevin put the silver chart from the 70s, we're in La La Land now. I'm not saying the price won't go up. It's in that trend. But if you're a short-term trader and you're jumping in here, you're going to get triggered out at any moment. You can have rug pulls. There's huge volatility there. You're gonna go bonkers, or there's a high likelihood they're gonna get triggered out if you're a short-term trader. So that's my rant about that there. I can't repeat it enough that, guys, next time you have a 2-year consolidation, take heed, for crying out loud. I can't, that was the time to be bullish. I was the most bullish on these breakouts. As the price moves up, Rob, I'm less bullish. Less bullish does not mean I'm bearish, guys. Don't overread what I'm saying. I'm less bullish because what do you want me to tell you? I'm on the highway. I've used all that gas scientifically. I can't tell you until I go to the gas station and fill up my car. I'm running on fumes there. Like it's just common sense, but people don't want to hear it. Like you said, there's narratives out there, and I'm fighting that constantly on Twitter, on X. People getting mad at me. I'm not allowed to post any type of non-uber bullish scenario. People get mad at me. No likes. People just want to hear me say, "Oh, 200. Don't worry, guys." But
Well, I think,
right?
yeah, to that point, I want to expound on that. If you look at what happened at AMC, I'm going to break us out of gold silver for just a moment to maybe illustrate a lesson for people. If you look at what happened to GameStop and AMC, that was a Reddit crowd it started on Reddit, but it was a crowd that got involved in pushing something up that was a penny stock, and that was a speculative play, but it was an emotional appeal. And there's a whole movie made on it as well about how this happened. It was emotional appeal because what you really had is you had a younger generation trying to find a way to survive in this world, given inflation, the economy, and stuff like that. And they're speculating on something to make money, to try to live that American lifestyle. And people capitalized on that and drove two stocks that had no business, being at those levels up. And so I see this in the gold and silver space. People are latching on, and it happens in Bitcoin too, but people are latching on to the gold and silver and they're saying, oh, they're going up. And I don't know if that's AI guy or who's behind it, but they're trying to drive it through sentiment. But one thing I want to caution people about, this is not AMC and this is not GameStop. This is gold and silver. These have been money for 5,000 years, and these are big playgrounds in which you have sovereigns playing and you have a lot of money. And these are major markets that are very, very old, much older than our current stock market, much older than our current energy market. And that's something I want to caution people about. That sort of play into gold and silver is not going to work. It goes back to your early comments about how many people play in these markets. You're not going to drive silver through a social media sentiment or that type of thing to where you want it to be. This is different than a couple of penny stocks. And I just want people to be cautious about riding that wave, especially if you're new to the gold and silver space and you're thinking Bitcoin or you're thinking penny stocks or you're thinking even Forex. These are not the same markets. These are very old markets. These are markets that have implications for the future of the US dollar. And so the forces that are in play here are much bigger than some Redditors and some social media sentiment type of manipulation. And I want people to be very careful about who they listen to and what they're listening to, especially if you're new to these markets. I don't want people to get hurt in getting in and not, meeting expectations because they were on Twitter or they were on Reddit and all of a sudden somebody said something and it got them excited.
Yeah, and look, just take a step back and look at evidence like this. This is the mighty NASDAQ versus gold going back, sort of 40 or 50 years. So it peaked 25 years ago. Overall, since that peak, the NASDAQ, from that peak, you can talk about cherry picking if you like, but overall, the NASDAQ has not made new highs versus gold in 25 years. Gold crushed the NASDAQ for over a decade, and you can also talk about dividends and that kind of thing as well. But of course, these days, gold can earn a yield. We know that you can earn a yield holding gold digitally, so take that into account as well. Times have changed and times have moved on. But anyway, just looking at the pure ratio chart between Nasdaq versus gold, what's happening at the moment? It's broken below critical support. It's broken below the long-term moving average. It's broken below the Ichimoku cloud there. We are in a bear market for the Nasdaq versus gold, and the most recent bull market did not even make new highs versus 25 years ago. How pathetic is that? Does that not tell you that there is something going on here? At the very least, you need to be aware of this. Okay, you can choose to ignore it if you want to, but if the Nasdaq is now down, and I'll just put the candle chart on there so we can get the get the peak. So if the Nasdaq is now down something like 66%, priced in gold over the last 25 years from its peak, okay, that was a dot-com, the peak of the dot-com era. But nevertheless, everything that Nasdaq has done since then has failed to take it back to those levels, and we are now in a new bear market. So that is something that every investor needs to be aware of. And as you say, if you're on social media and people are saying, well, let's go all in on tech stocks, let's go all in on AI. Well, I would be completely on board with that if the Nasdaq wasn't breaking down versus gold. That's not what you want to see. You don't want to see the Nasdaq in a bear market priced in gold if you're about to go all in on I don't know, Nvidia or whatever the latest flavor of the month is. Some AI related tech company. It's not what should be happening if we're about to be in a significant long-term bull era for tech stocks. Yes, we could have some kind of blow off move in some of those stocks, and we could see this ratio going back up here and then doing something like that. I'm not going to rule that out. That's possible. But until we get above that long-term moving average and above the Ichimoku cloud, and preferably actually break out above that wretched resistance line there, then until that happens, I'm not on board with a long-term bull era in stock markets and tech stocks, because that's what has to happen. The work that the chart needs to do to give you the evidence that you need to have the confidence to say that we're in a bull era for tech stocks versus gold, the chart has to do that work first to deliver the evidence, not the chart. When I say the chart, I mean the market participants. And as you quite eloquently said, Rob, the aggregate of market participants are what is carving this chart out. It's speaking to us. And if you learn the language of the chart, what you're really doing is you're interpreting the aggregate of market participants and their actions, not what they choose to put on social media, not the fact that we've got a crypto-friendly president in the United States, or that we've got ETFs enabling massive inflows, or that we've got, I don't know, M2 money supply going to the moon, so therefore Bitcoin's got to go to the moon and everything else. Those are all narratives that have failed. Fail after fail after fail after fail. What hasn't failed is this technical chart. It broke below critical support back in March, and since then we've seen stock markets struggling to make much ground. We've seen Bitcoin and the crypto market rolling over, and we've seen gold continuing to massively outperform not just the S&P, but the Dow Jones, the Nasdaq, and all the other stock indices. So what hasn't failed is technical analysis. What has failed, and what has led us up the garden path, and is probably doing so by design, is all the narratives that are thrown out there. You've got people putting stuff on social media that's suggesting one thing, while secretly, of course, they're doing something else. Of course, they want you to be their exit liquidity. They want to get out at 120,000 or 110,000 just before the market goes down to 40,000 Bitcoin. They want you to be their exit liquidity. You can avoid that by using the technical chart.
Hey, Kev, can you put the distance per moving average on that chart? Because this is another play people could do. So let's say I'm forcing you, you want a balanced portfolio, not financial advice, but I'm telling you, you have to own tech stocks, NASDAQ, or you have to own gold. When you have that chart, people could actually play a ratio chart, because here in this case, if this is going down and you want to profit from it, then you go long gold and you short the NASDAQ, and you would reproduce the same percentage moves in your portfolio as that ratio chart. But this is the difference here. Look how the NASDAQ is not that stretched from its 36 month moving average to the downside. So there's still a lot of room, no matter what gold or NASDAQ does individually. They could both be going up in price or down, or whatever variation you have in that ratio chart. that thing is still trending downwards. So, and we're not stretched from that moving average, right? You could still, before the NASDAQ hits a bottom in relative performance versus gold, people could actually like replay that chart. So there's a lot of moving parts. People that, gold could be stretched, ready for correction. All that stuff is still out there, it's still the truth. But from that racial chart, you can see there's still a lot of room down for the tech stocks priced in gold, right? It doesn't mean this goes down because gold's rocketing, right? It's a huge correction, like a super CRE correction, that the gold and the NASDAQ could be going down and that ratio will be plummeting. But because your gold will be going down less, if you're holding gold instead of NASDAQ, then you're actually you're gaining on that there. Look at that. That chart, the diminishing momentum, the distance from that 36-month moving average tells a whole story, guys. It tells a whole story. You cannot be bullish anything tech as long as that thing, it's imploding relative to gold, So the evidence is there, and it's just starting. Well, I guess it's not just starting to roll over. It started rolling over like over a year ago. We had the retest of that critical support line that just failed. Now we're 5-6 months down in, so it's not super early, but you're not. That's when I think like silver's going to go whatever the $300, $400, whatever, like, or oil 300, 400, gold 5 digits, easy. But it's because of that. There's so much fuel left in the gas tank. My goodness, it's just crazy there.
I mean, some of those early charts that I was talking about, for example, currency in circulation versus gold. This is why we were starting to get really bullish on the precious metals markets back in sort of 2023, 2024, because if we just take a look at currency in circulation versus gold and what it's telling you, in the 1970s, it plunged priced in gold. Currency in circulation was in a bear market priced in gold. It did the same in the 2000s. And this pattern that I keep showing you, where you get this kind of, let me just get the drawing tool there. You get this 1, 2, 3, and down she goes. Whatever you want to call that pattern, and that's not a classic head and shoulders pattern, but whatever the hell it is, you get this kind of attempt, 3 attempts, and sometimes it's 2, sometimes it's 1. Here it's just 1 rollover. But when you're failing to break out and make new highs, and then you start breaking down below the moving average. Something else to remember, Rob, is that people will draw their technical charts in different ways. You see where I put these lines on the chart. You get somebody else will come along and they'll put lines in different places, and anything that I draw on the chart, that's me. It's my interpretation. But what isn't my interpretation is the moving average and that thing there that I keep referring to, the Ichimoku cloud. Bear markets occur below them and bull markets occur above them. So if you're putting a long-term moving average on, like the 3 or 4 year moving average, the main bull market thrust occurs above the Ichimoku cloud, above the moving averages. When price starts to interact with those, then you've got a potential developing problem. It could resolve to the upside, but it could also resolve to the downside once price starts interacting with those indicators. Once you get a clear downtrend developing and you break down below your manually placed, manually assessed support line, then you've got weight of evidence that you are entering a phase where the chart is much more likely to continue to drop. And of course, that's exactly what's happened here, as currency in circulation has massively underperformed gold price. And the very same thing can be seen with charts like the US dollar index, DXY versus gold.
It's so stretched on the downside. It's like, that ratio is looking to go back up there.
Yeah,
so
looking for bounces on all of these.
Yeah, either gold correction and or an increase in performance of the other asset class. So the DXY, could be in a little bull run now. I'm noticing some stuff happening on the daily chart. If it manages to hold ground there, the DXY could actually go up there relative to the euro and, well, US dollar versus euro and a whole bunch there. And if gold goes sideways or goes up, but doesn't go up as fast as the DXY is going up, then you're going to have a relative outperformance of the DXY versus gold on that chart. And they're so stretched at the downside, mathematically, you have to expect we're approaching this type of situation where the gold's relative performance versus all the other ones there, it's going to go in the other asset classes are going to start outperforming gold on the shorter term within that, super cycle. And like Kevin showed those charts are, and you cannot, and people like,
I think maybe it's going a little bit sort of under the radar here, but currencies like the euro are showing some good relative strength versus the US dollar here in terms of the macro picture, not talking about sort of day to day and week to week moves, but charts like the Swiss franc versus the US dollar massively outperforming, even the British pound showing a breakout versus the US dollar. This downtrend has now ended, and the British pound is now consolidating that recent breakout versus the US dollar. I've got no idea why the pound has moved up from parity to 1.3. It's moved up something like 35% versus the US dollar from the low point that it was at a few years ago there. The Aussie dollar is very close to break. In fact, it probably has broken out now versus the US dollar. So, there's stuff going on here. Okay, it's in embryonic form here and it's very early, but this is exactly the same sort of thing that we saw when the 10-year yield broke out of its 40-year downtrend and the US 10-year yield broke above that resistance line that had been containing the price for 40 years. We broke out and we've been consolidating around the 4% level for what seems like forever. But we are in a new era, Rob, for
that's good. That's
not
right.
just for gold and silver, but for things like the 10-year yield.
Showing that what happened, zoom out there. Yeah, do you have this? This is the data that goes forever. Yeah, show them all the data there. You know what? Is that the one that has all the data? Yes. Yeah. Zoom out there. Minimize the pane on the right, so we have all the data there. And yeah, zoom out. Well, zoom. I want to see all the data. I want to show everybody the big picture there. The big picture, everything there. Okay. You see how that bottom, the interest rates going down from the 1920s all the way to the 1940s? That's kind of what we had from the 1982 all the way to the 2000. We started bottoming in the 2016, and then we had that blow off bottom, at meltdown. And look, we're starting turning up right now. I don't know exactly where we are, but maybe because the metals are outperforming the stock market, that's why we're pinpointing that we're close to 1968 around that region. So it's this, if somebody wants a narrative, what is it higher macro than yields? Like that guides everything. The yields drives everybody, their profits to margin, the long-term expected. Like the yield is practically defines everything. And that chart, if that yield still holds up, even if, let's say we have a recession and those 10-year yields get a suck down, a temporary suck down, and the 2-year yields get a temporary suck down. And that's kind of what's happening with them lowering the rates. It's actually the 2-year yield, the 3 months, all that stuff's like, because they're sensing the unemployment rate going up and all that, economic business cycle stuff. There's a suck. But the longer trend is that's a higher high. We're probably going to carve out a higher low, but that's a secular inflationary era that we're entering. And that is so akin to the 1970s, even oil, I see like $300 oil by all this is done. This is crazy, crazy stuff there. And if people are analyzing markets today and they're not zooming out and they're not showing you a 200-year or 100-year chart of the yields, they're missing part of the picture. It's not that I want to discredit people looking short term. It's like people focus on the Bitcoin cycle, but they're not looking at Bitcoin price and gold. They haven't noticed that it's been rolling over versus gold. That's not good. Bitcoin is not supposed to roll over price and gold in the bull era. It's not supposed to do that. US equities are not supposed to roll over versus gold if they are supposed to be in the bull era. And only if you look at the yield charts with over 100 years of data can you get any idea of what's happening here. And yeah, guys, just zoom out there. You need data. My goodness.
Yeah. As we get in the last part, don't want to go too long on this one. We're going to hit an hour here pretty quick. Just summarize, maybe come off of the charts for a moment and just kind of summarize your views on maybe looking at gold and silver for 2026, but maybe the next couple of years. What is your viewpoint on gold and silver? And how do you think that reflects on what you were the talking points? Summarize the talking points about the economy, gold and silver. What's your view for the next year to 2 years?
Well, what I would say is that the next massive leg up for gold and silver is likely to come after whatever form of stock market weakness that we see developing. So how the dynamics work when the stock market breaks down and how the miners react to that and how gold and silver react, we'll need to analyze the charts in real time on the smaller time frames to pick out the detail on that. But zooming out and looking at the macro picture, we've had a fantastic 2025. We're now looking to this phase concluding, whether it's at $80 silver or $120 silver, whether it's at $4,500 gold or whether it's at $5,500 gold. But we're looking to this phase to come to a conclusion and culminate in a significant corrective period, which in my view would be likely to last for many months. And I think that's quite likely to coincide or be associated with this sort of developing weakness in the stock market. But in the interim period, I think it's quite plausible that we have one last sort of gas move up, not just for stock markets and precious metals, but Bitcoin and so on. But I think 2026 is a year fraught with danger for investors more generally. And don't forget, I'll just finish by saying cash is a position. Pat?
Yes, well, that's right. Look, this is the warning sign is gold, silver outperforming the stock market. People better take heed. That's your first warning sign. And the second warning sign is when the stock market is going to start roll over. But it could even be in the 60s. In the late 60s, silver started rolling over 6 months, I think, before this, or 3 months, I forget, before the stock market showed any weakness and started rolling over. And because mathematically gold is stretched, silver is stretched, the miners are uber stretched from the moving averages, they might actually start rolling over, sensing this liquidity exit, because if you're stretched mathematically, then it's just easier to take profits out because that means there's more people that are already in the money that bought lower that are going to want to bail out. So we're watching very closely all these crazy charts that are going parabolic. We're watching them for any type of rollover. And after that, if ever all the US, if the precious metals start correcting, then it's not because the stock market is going to go in a new bull era. I suspect highly that it's because they're sensing the incoming implosion and then the stock market is going to start over. 2026, that's 12 months, Rob. It's a lot of time. You don't try to call tops. People have been calling tops, 2022, 23. Like it's a tricky business calling tops. What we could do is look at the evidence. Once it starts rolling over, then we could increase the probabilities that, okay, this piece is locked in, that one's happening. So we just have to wait now. Who's going to roll over first? And if the stock markets start rolling over, then it's a super CRE time. And then after that, if you want to stay on the sidelines, let the dust settle, and then you could stack up, buy whatever you want on the cheap on the recovery side. There it should just be crazy because all that essentially gold, silver, they're sensing that destruction of purchasing power that they're going to do to save the economy, right? I didn't show that chart, maybe for another time, that the total public debt of the US government, when the rate of change of that thing starts exploding, and now it's rock bottom. The debt, I know it's super high nominally, but the rate of change is too slow right now. They haven't been printing enough. I know 75 trillion, I don't even care. It's just a number. It's a fiat illusion, right? And as soon as that goes up, every single time the rate of change for the total public debt goes up, recession, and that creates vulnerability for the markets.
We haven't mentioned much about Bitcoin and cryptocurrencies, but one thing I will just say, it's going to be fascinating for me personally to see whether Bitcoin continues its correlation with the stock markets or whether it somehow starts to correlate more with precious metals. I know a lot of people talking about
Bitcoin. Well, it doesn't correlate with this. What?
No, well, this is what I'm saying. This is what's going to prove our point. This is what's going to prove the relationship that where Bitcoin falls in terms of investment category. Up thus far, Bitcoin has no real correlation with gold, except sort of happenstance when they both for a short period of time move up or down together. But zoom out, and Bitcoin doesn't have that correlation with gold and silver and precious metals and so on. What I'm going to be interested to see is on the recovery side whether Bitcoin can outperform the S&P strongly, and whether at any point it can outperform any of the precious metals. It's going to be interesting to see, but we know what we know in terms of gold and silver. It's going to be interesting to find out with the younger assets of cryptocurrencies just where they fit into it all long term.
Yeah, very good. Thank you guys for joining. I appreciate it. I think there's more to talk about, so we'll definitely have you guys back on. real quickly in about a minute, tell people where they can access your information, find you guys. I think you guys have a lot of good stuff. I want them to follow you on social media and follow your website and those types of things.
Yep, well, you can find me at Northstar Charts on X, and we've got our website, northstarbadcharts.com.
That's right. And some of my stuff, Badcharts 1. Somebody took Badcharts. Can't do anything about that. On X, and like Kevin said, our website there. That's where we got everything. All the commentary, the nuance stuff, all the details. The interactions with our members. It's all behind the paywall, guys.
Thank you, Pat and Kevin, for joining. Appreciate it. Till next time, this is Rob Keents with the Freedom Report. And this will be our first video of this week. We'll have another one of myself as well as we continue to produce content. Stay tuned to this channel where we're not going to pump you with false information, but where we're going to do real analysis and make sure that you guys are prepared to understand not only what's going on with gold and silver, but what's going on with the general markets. And we do it all for free just to support and help you through what we think is going to be the next few years of troubling economic times. Until next time, this is Rob Keents with the Freedom Report.